Hey guys, welcome back to Investing with Cole, and I've been enjoying a lot lately having these serious kind of sit-down videos where we go over the psychology of investing, just broad stock market things so you can get a good understanding of investing as a whole. I don't want my channel to be, oh, what the Fed just said, or, oh, look out for this week in investing. I don't want it to be this useless info it's never good. The videos always suck, but even if they were good, they'd be out of date after like a week. They're on such a small, short-term topic that I don't think it's worth your time to watch. So I like doing these broad videos that, you could watch them 10 years from now and they're still going to apply. But I have been getting a lot of requests from viewers to mix back in some of these reaction videos, kind of more humorous, kind of just going over bad content on YouTube. And luckily for me, there's an endless supply of bad videos. And these are fun for me to make too, so I didn't really have a problem going react to some stuff. And so this is a video that someone wanted me to react to from Everything Money. It's called ETFs, How to Retire with Them, and the Types of ETFs to Buy. And this is my first time watching the video, so it's going to be my live reaction. And just to reiterate, because I know a lot of you have a low IQ, this is a live reaction in replay because I already saw the video. So you don't need to go to the comments and say this isn't your live reaction to the first time watching it. You already saw it. Yeah, I know that. That's why it's called a replay. I'm probably smarter than you are. So it's okay. Let's get into the video.
ETFs are a great way to set yourself up for a really great retirement and not have to worry about a financial advisor guiding you on this. So right now, I'm going to run the gamut on ETFs. This is going to be a longer video. You should watch it twice. You're not going to get it the very first time, especially if this is new to you. I'm going to go through different ETFs.
Okay, so I just wanted to highlight that for you guys real quick. He says he's going to be running the gamut on ETFs. And running the gamut means to experience, display, or perform the complete range of something. So this is going to be a masterclass of ETFs. It is going to be one of the most comprehensive videos of all time. So comprehensive, in fact, you're going to have to watch it twice. There's no human on earth could watch this video once and absorb all the knowledge. So just keep that in mind as a context for this video.
First of all, let's look at the first one, and this is SPY. This is the most common one out there. It's the S&P 500. And
okay, so yeah, this makes sense for, I think, a good, I would probably start with an S&P 500 index fund too. I think it's a good place to start. Makes sense.
that is exactly what you're doing. You are buying all 500 stocks broken down, weighted into different categories, and it is very...
I just want to point out, I don't know what happened there with the editing. I don't know if you guys saw that. They had two cuts in like a 3-second interval. I don't know what happened there, but let me just show it again for you guys.
Broken down, weighted into different categories, and...
Yeah, I don't know what that was. That was weird.
And it is very low cost. I think that the cost basis on this thing is about 0.09%. So...
Okay, so first major issue with the video, we're running the gamut on ETFs. You're going to have to watch this twice. What was the first thing he says about ETFs, basically? Well, we're less than a minute into the video. And this guy just said, the cost basis of SPY is 0.09%. Did you catch it? Did you catch the fact that he was trying to say expense ratio? Cost basis is the price you pay for something. So like if you bought SPY for $300, your cost basis would be $300. 0.09% is the expense ratio. Cost basis is not the cost to operate a fund. And I get that people misspeak. I'm a lot less lenient for big channels like this because they do this full time. They make like over $1 million a year from their courses. They have a staff of people that help make the videos. So I'm a little less lenient that somebody would call an expense ratio a cost basis, but I do understand sometimes you have a brain fart, you misspeak. But he says it for the entire video. The entire video for every ETF, he calls the expense ratio the cost basis. So it's not like he got tongue twisted one time. He thinks that's what cost basis means. He runs an $80 a month day trade course promoting that you will outperform the stock market if you buy his course and get 12 to 20% returns a year, then goes on to promise he's going to run the gamut on ETFs. You're going to have to watch this bad boy twice because it's just such a great video about ETFs. Doesn't know possibly the most important term when it comes to ETFs. Especially with S&P 500 index funds, especially with ETFs that track an index, one of the first things you're going to go look at, what's the expense ratio? I pray someone is not trying to learn for the first time, clicks on this video, and spends the next day Googling what's the cost basis of SPY and getting confused that they can't find what the expense ratio is. I'll tell you one thing, if I made a mistake in a video, like a mistake over a simple term like this, and this is my full-time job doing YouTube, I'd remake the video. If this is some dude with 10,000 subscribers, trying to make videos about investing, I would tell him, hey, you shouldn't have simple errors in it over what should be simple terms. But I would understand it. This, I don't understand it. How could you possibly, as your full-time job, be making investing videos, charging people $80 a month? You don't know what the word expense ratio is. This would be like if I was watching Linus Tech Tips on a video about how to make a computer, and he's like, okay, the first thing you want to do is get your CPU, and he holds up a monitor. I wouldn't watch the video. Like, yeah, I can figure out what he's trying to say because he held up a CPU. He called it a monitor, but he held up a CPU. I can understand he meant to say the word CPU. But the fact that he doesn't know the difference between those two, I would not watch a video on how to build a computer from someone who doesn't know the difference between a CPU and a monitor. It's such a small mistake, messing up one word that speaks volumes about the entire channel.
The great thing about SPY, it's letting you buy every single stock in the stock market, in the S&P 500, I should say. So you are getting a piece of everything. Let's go down to the holdings. Top 10 holdings right here. So you are getting Apple, Microsoft, Amazon, Facebook, now Meta, Google Class A shares, Google Class B shares, Berkshire Hathaway Class B shares, Tesla. You can come over and go to a Vanguard ETF. Remember, let's break this down and look at these holdings. Very similar cost.
Mr. I'm running the gamut on ETFs. You're gonna have to watch this bad boy twice. We go from an S&P 500 index fund. Now we're shifting topics to an S&P 500 index fund. This would be like if you hired a driving instructor, but instead of teaching you how to drive, he just taught you how to parallel park in a Honda and then in a Mazda afterwards. He's not too. We get the concept of an S&P 500 index fund. Move on to something else. We get it.
Cost basis and come down and look. It's almost the same. Apple, Microsoft, Amazon, Facebook, Google Class A, Class B shares, and it is literally almost the same and almost the same breakdown. So when people ask,
that is fucking insane that two S&P 500 index funds have the same holding. We're running the gamut on ETFs.
Ask me, hey, what's better? Is it Vanguard or is it S&P?
This is something I don't think I would point out if it was not for every other thing he says wrong in the video. But he keeps calling SPY, he keeps calling it the S&P. He calls VOO or Vanguard. He's going to talk about, spoiler alert, he's going to bring up a third S&P 500 index fund. He's going to call that fund by its name. So every S&P 500 index fund, he calls it by the name of the fund, except for SPY. He calls SPY the S&P, which makes me think that I'm worried he doesn't know that SPY and the S&P 500 are different things. I think he thinks the S&P, when you say S&P 500, I think he thinks the S&P is short for SPY. Like, I think he thinks they're the same thing. You just pay attention to it throughout the video. He's going to keep calling SPY the S&P, but he doesn't do that for any of the other funds that track the S&P.
I look at it as it's personal preference. There might be a couple of basis point beats to one side or the other, but overall, I look at it and say, you're probably going to do very well over a long period of time buying SPY or VOO. Now, I did a
It's not totally a negative reaction video. I completely agree with Mo on that. Some people disagree with me on that. I say if somebody comes to me and says, should I invest in SPY or VOO? I mean, I'll tell you VOO, but that does not matter whatsoever. 0.03 versus 0.09. There are much more important decisions you're going to make. Like, imagine somebody's like, oh, I'm so smart. I bought VOO because they have a lower expense ratio. Meanwhile, they hold it in a taxable account. They've never even opened an IRA. Somebody opening an IRA and buying SPY in it, they're going to do way better than somebody holding VOO in a taxable account. So it's, this small 6 basis point difference on ETFs, really not a big difference. So Mo's completely right on that. You are not going to be broke because you bought SPY or because you bought VOO. That's not the important thing to think about. Much more important to think about your income, taking the tax advantages that you have available to you, saving as much money as you can. Those are the important things. So I want to agree with Mo there. He's right that it's really not a big deal which one you choose.
I want to look at this this ETF called SPLG. This is a spider ETF that is smaller. It only costs you $48.50.
We are running the gamut on ETFs. We're going to teach you everything about ETFs. Here is our third S&P 500 ETF, and the second one from Spider. You could make a video discussing different S&P 500 ETFs. You can make a video on that. I wouldn't make a video about ETFs in general, and my first three all be S&P 500 index funds. You get the point after one. This would be like if I made a video about like world culture and like all the different cultures in the world, but like I just went outside and just talked to my neighbors, and people proceed to congratulate me. People are like, "Wow, you ran the gamut on the entire world." Come on, dude.
Sense as of this moment, and the breakdown is very, very similar. There's another video that I actually did a comparison to these, and these are almost identical breakdowns.
That's probably because they're both run by Spider and they both track the same index. If I had to guess, that would be why they're similar.
Identical holdings and weighted averages, and this one actually costs a little bit less. The cost basis on it is about.
It's not what cost basis means.
0.03%. So if you come down here and you look at it, you notice the breakdown to S&P asset percentages is almost exactly the same, and you have it: Apple, Microsoft, Amazon, Google Class A and B, Berkshire, Tesla, Nvidia, JP Morgan. Now, what's the main difference? The main difference, and what would make me want to go if I only had that much, go for S&P versus SPLG.
Did you see what he did there? He calls SPLG. He calls it SPLG. He doesn't call SPY. He calls it the S&P. They're both S&P 500 index funds.
Go for S&P versus SPLG?
I seriously think he thinks SPY is the S&P 500. I think he thinks they're the same thing.
So when I look at options, and guys, if you don't understand these options that I talk about, there's so many videos that we break down what we do as far as selling.
The amazing part here is he's like, guys, if you don't understand options, he's about to show that he's a goddamn moron. I was gonna say this is worse than the expense ratio cost basis thing. It's a tough call because the expense ratio thing is so simple that any moron should know that before making a video about it. Options are a little more complicated, so I could understand someone making a mistake in a video about them. But he's like so wrong about this that my brain exploded. You know how at the beginning of the video he said you're gonna have to watch this twice to understand it? I've watched this 3 times. I still don't understand it. So you guys are in for a ride. Let's watch this. And before we even get into this, just a quick aside, maybe this will be a whole video at some point. You shouldn't be selling covered calls on your index funds anyway. The whole point is you're going to buy and hold them for decades. You shouldn't be opening up positions that force you to sell them. So it doesn't make sense in the first place to do covered calls. But even if it did make sense, even if it did make sense to sell covered calls, nothing he says here makes any fucking sense. Let's get into it.
What we do as far as selling covered calls and cash secured puts. I'm getting my words twisted.
Do you see how they had a cut there? Did you see that cut?
As far as selling covered calls.
I'm pretty sure the reason there was a cut there and he had his eyes closed having a Jimmy Neutron brain blast is because this guy doesn't know anything about options. So he didn't know the words covered calls and cash secured puts. They totally had to pause there. Somebody had to tell him off camera. And he's like, oh yeah. Because the guy clearly knows nothing about options.
Here we go. S&P. Let's say that we want to, current price is 413. Let's say that we want to sell a covered call on the S&P at, let's see, what price should we go to? September 23rd, 2020.
Okay, keep this in mind. It's kind of important. We're selling on SPY. He's comparing SPY and SPLG. We're selling a call on SPY expiring September 23rd. Just keep that date in mind.
450 is going to give us about 23 cents a share, and our delta is about 3%. So the delta means that you are going to have about a 3% chance that this event occurs. So the event that's going to occur is that the S&P 500 is going to be at $450 a share.
No, it's SPY is at $450. The S&P 500 would be at $4,500.
By the September 23rd date. And you are going to collect 23 cents a share for...
If you're not familiar with covered calls, let me just break something down for you real quick. Let's say you don't own any SPY right now. In order to sell this contract, you would have to go buy, at the current price, $413, you'd have to go buy $41,335 worth of shares. $41,000 worth of SPY shares so that you can make $23. $41,000 to make $23. Is this really why you would choose SPY over SPLG? Because you can make $23 for every $41,000 of capital you have? And even if he was right, just hold on. He's about to put his foot in his mouth.
For doing so. Now, let me compare this to SPLG. So I'm going to go by a 3 delta. Let's pull up SPLG and let's just scroll down here and see where we can find a 3 delta on September 23rd. It's going to be September 16th. Let's see a 3 delta. So
there is a reason, okay? There is a reason that the last time I reacted to Mo, I did not use a face cam. You may notice I'm not using a face cam right now either. There's a reason for that. It's because I am fucking seething right now watching this guy talk. He is trying to explain to us that SPY is more lucrative than SPLG when it comes to options. He doesn't even compare the same expiration date. This was posted August 30th. So it's a difference of 18 days to expiration and 25 days to expiration. That's almost a 50% difference. Mo, do you think maybe comparing an option 2 weeks out is going to be different than one 3 weeks out? This would be like going to a restaurant and seeing on the menu there's a 6-ounce steak for $30 and a 9-ounce steak for $40. And Mo's sitting there going, well, why is the 9-ounce steak more expensive? It's the same steak. He doesn't even know how to compare things on a comparable basis. You can't just have drastically different expiration dates on short-term options.
3 delta is going to be, it's going to pay us about 5 cents a share. So you see, and the odds are that you actually get this at 5 are very low because there's very low volume on it. But what you can see, and here's your delta, is that you get paid more for SPY versus SPLG. And to me, as somebody that likes to do options, and I know a lot of you do, or you want to get into it, this is why SPY would be better for you in the long run.
Has anyone noticed the other problem with this? Not only are we on completely different expiration dates, he compared the 450 call controlling $45,000 worth of shares with what was it, like the $54 call comparing $5,400 worth of shares? If you do not own any of these stocks right now and you want to go sell these contracts, you can either go buy $4,800 worth of SPLG and get $5, or you can go buy $41,000 worth of SPY shares to get $20. What was it, like $23? So let's think for 5 seconds. Let's say, I make an extra $15, but I need an extra, $36,000 of capital? It's okay, guys. You only need 9 times as much money to make 4 times as much money. This is why Mo prefers SPY, because you can spend 9 times as much money to make 4 times as much money. Now, obviously, he's covering it now. The bid on that contract was 0. It looks like some have sold for 5 today. So whether you get filled at 5 or not, I'm not sure. In his example, he said 5. So not even mentioning the different expiration dates. So in this guy's mind, if he had to buy $1 million of a share to sell options on it and made like $20, he would think that would be better than making $5 on like $1,000.
Go to some other ones. Let's go to some sector-specific ETFs. One that I like to...
Okay, guys, we are halfway through the video. We are halfway through the video running the gamut on ETFs. And for the first time ever, we're gonna talk about something that's not the S&P 500.
To participate in is Jets. What this is the airline ETF. So let's go and look at the holdings of Jets. We have...
Out of every... This is what I'm so confused about the entire video. You spend half the video talking about the S&P 500. We finally branch out, and you go, oh yeah, one I really like is Jets? I would be hard-pressed to think of a worse investing sector than airlines. Why are you interested in Jets? The thing is negative since inception. If you invested in this the moment it came out, you would be down money. So I question, why even bring this up? Because once again, the title of the video is ETFs, how to retire with them. You're not going to retire on jets. You're not retiring on an airline fund that is down since inception. What a goofy idea. And what's amazing is this isn't even the worst ETF he's going to recommend to you.
Average, that is, you're not just getting smoked one time, you just owned 10% of United Airlines, 10% of Delta, and so on and so forth. Now, you could also go into some futures ETFs, USO.
God, just real quick. For some reason, he spent the entire S&P 500 thing talking about cost basis, you know. But for some reason, at no point he stops bringing up the cost basis, aka expense ratio. He never brings those up for any of the other funds. And I can see why, too, because this Jets ETF has an expense ratio of 60 basis points. It's 20 times more than VU and SPLG. I mean, good God, imagine paying 60 basis points a year to invest in airlines. You're paying 20 times the expense ratio of VU to lose money. That's a bad deal. That's one I'm not going to take.
Oh, this is something people always ask me, what's one of my biggest investing regrets? Especially in 2020, this happened. I bought USO. I did not understand futures, okay?
Guys, I am shocked. I am shocked that Mo from Everything Money, the guy making like $1 million a year from his day trade course, I am shocked that he would just randomly buy a fund without reading the prospectus or the investment objective of the fund. I'm shocked that he would do that. Also, back to the title of the video, ETFs, how to retire with them and the types of ETFs to buy. Why would USO ever come up in this video?
Okay. I still don't have a great grasp on futures, so therefore I tend to stay away from them. But what this is, it's a fund looking at futures of oil in the United States. So if you wanted to, you could go in here and start buying some of these futures, and here's your breakdown. It's going to tell you exactly where it's pulling from. Crude futures contracts is the majority of where it's coming from, and then you go down from Fidelity to Goldman Sachs futures, etc. These are a little bit more risky, and I need you to understand them before you go and do them. Don't just think oil's going to go up, I'm going to go buy it. Sometimes they don't work that way. Now, there's something else that I do.
Okay, I at least appreciate that he said just because oil goes up doesn't mean USO goes up. But it makes you question, why is USO in the video? Let's go to the prospectus right here for USO. You can just Google this. The extent of Mo's research into USO before he bought it was contango. Yeah, I love to dance. That was the extent of what he did. The investment objective of United States Oil Fund is for the daily changes in percentage terms of its units NAV to reflect the daily changes in percentage terms of the spot price of light sweet crude oil delivered to Cushing, Oklahoma, blah, 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 blah. And then we get over to here. It is not the intent of United States Oil Fund to be operated in a fashion such that its NAV will reflect the percentage change of the price of any particular futures contract as measured over a period of time greater than 1 day. So we're taking a fund that's supposed to give you short-term exposure to the price of light sweet crude oil, and we're putting that on a video called ETFs, how to retire with them and types of ETFs to buy. Instead, you know what I found in like 5 seconds? I found this, VDE. I'd never even heard of it before, but I found it in like 5 seconds. Vanguard Energy ETF. Guess what? Instead of oil futures, guess what this is? Oh, look, it holds actual oil companies. It holds actual oil companies. If you want exposure to oil companies, check out VDE. I'm not recommending it. I recommend VDE over USO if you're planning to hold this for the long term. Because USO is definitely not an ETF to retire on. In fact, let's just look. VDE over the last 5 years up 27%. USO over the last 5 years down 8%. And if we go to the full-time chart, VDE has more than doubled since 2004, which is as far back as this chart goes. USO down 87% since 2006. If you bought this when it launched, you're down 87%. Does this sound like an ETF to retire on? The moment he left an index, the moment he left the S&P 500, This dude's suddenly recommending you ETFs that are down all time. Jets, down all time. USO, down all time. This is not good. This is not good.
Gold. I get a lot of questions about gold. I am not the person that's going to go buy physical, tangible gold. That's just not for me. I see that as, what am I going to do with a piece of gold if everything hits the fan? I better buy a really sharp razor because I'm going to have to go and start shaving off pieces to go and buy some bread. But I will go buy a miner's ETF.
This is not like a super serious counterpoint, but I would question what he's going to do with a share of a miner's ETF in the event of a post-apocalyptic world.
So this is an opportunity for people to go and buy gold and have that downside protection. If one company gets hit, you are not going to get blasted, and that's something very important. Now, when we start talking about one company getting hit and getting blasted in an ETF, that takes me to ARK. You should not have an ETF that is down 50, 60, 70% in a year.
I'm sorry, I've never looked at gold miner ETFs before, so I just pulled this one up. As a joke, I clicked on the all-time chart. I am shocked that for a third time in a row, on a video about ETFs, how to retire with them, he's for the third time in a row has recommended an ETF that is down all time. How bad is this guy at picking stuff? How can you possibly make a video saying I'm gonna run the gamut on ETFs? Make sure you watch this twice. ETFs, how to retire with ETFs. Here are 3 ETFs that are down all time. What the hell is this video? It doesn't know basic terms like expense ratio, doesn't understand option expiration dates or capital required to sell the contracts.
Not going to get blasted, and that's something very important. Now, when we start talking about one company getting hit and getting blasted in an ETF, that takes me to ARK. You should.
I'm not defending ARK. I'm not defending Cathie Wood. I'm not recommending that you invest in ARK. I'm just amazed that the only ETF in this entire video, the only ETF he has shit on, is the one that is up. ARK has doubled since inception. Every other ETF he listed it has lost money for years. The only ETF that's in the green, he's like, well, this is dog shit. What the hell? It's just ironic.
Blasted in an ETF. That takes me to ARK. You should not have an ETF that is down 50, 60, 70% in a year when the stock market is down 20%.
Why not? Mo, the goal of an ETF is not to track the market. Why? It doesn't make any sense that an ETF should not be down more than the market. Of course it can. I bring this up because everything money video I've seen about ETFs, they think ETFs are index funds and they think mutual funds are actively managed funds because they always say ETF to mean index fund, and those are different things. The first ever index fund that people could buy was a mutual fund. So I don't get why you would say it doesn't make sense that an ETF could be down more than the market, because the ARK is not trying to match an index. He has this image in his head of what an ETF should be, and because ARK doesn't match that, he's upset about it. Like I'm pretty sure at the end of this video he's gonna show like a biotech ETF or something. So the biotech ETF isn't a real ETF because it underperformed the S&P 500 this year?
Also, I failed to mention this. When I look at S&P, the SPY, and I go and look at the holdings, go and look at some of these companies that are in these holdings. Apple, Microsoft, Amazon, Facebook, Google. These are some of the best companies in the entire world. Now let's go and look at ARK Innovation, ARKK. And I can tell you with certitude that those companies that I just pulled up, they make money. These companies here, Tesla, they do make money. Roku, Teladoc, Square, Zoom, Shopify, Spotify, Twilio, Coinbase, Unity Software. We went through one time and we looked at the top 20 holdings in ARK. 17 out of those 20 did not make money. I don't know what kind of ETF that is. That's why I say this, yes, technically it is an exchange traded fund. It is a conglomerate of stocks that help you buy multiple stocks at the same time. But ETFs are supposed to protect you on the downside. This kind of ETF is going to crush you on the downside. That is why I am not endorsing something like this. I do not think that this should even be called an ETF. It is a total scam. Now,
so he just said, I understand it's an ETF, but it shouldn't be called an ETF. Meanwhile, it's the only one he's brought up that's made money. Yeah, in fact, I've got the prospectus right here. It says right here that the fund will invest in domestic and foreign equity securities of companies that are relevant to the fund's investment theme of disruptive innovation. And then they mention genomic revolution companies, automation transformation companies, energy transformation companies, AI companies. Once again, I'm not saying go invest in ARK. I'm not recommending the fund, but if you just take 5 seconds to read what the point of the fund is, I would read this and go, "Oh, I bet in a bear market it's going to fall more than the S&P 500." What I would not do is go, "Oh, they're investing in automation and AI. Oh, they shouldn't even be allowed to be called an ETF." It's a weird criticism based on a made-up definition of a word.
If you would like to get into some other, you also have inverse ETFs. This is your...
I'm sorry. We just went from ARK is a scam and shouldn't even be allowed to be called an ETF straight into, oh, here's inverse ETFs. Here's how you short the entire NASDAQ.
Inverse ETF of the NASDAQ, QQQ. Now let's look at the beta here real quick, 2.4. So this is a levered ETF. So what that means is if you have QQQ going up, SQQQ is going to be coming down. You notice it's down 1% today. Well, the NASDAQ, you can see, is down 0.5%. I'm sorry, the NASDAQ is up 0.5%. If you wanted to, and I'm not saying that you should do this, but if you wanted to, these are just other options of ETFs out there. I think this is very risky. If you wanted to short the NASDAQ, if you want...
Yeah, Mo, I think that's underselling it a little bit. Going short the NASDAQ? Just in case you were wondering on this video about how to retire with ETFs, I did want to point out, just again, after the S&P 500, ARK is the only ETF he's shown that is green all time. SQQQ is down $500,000. It's down 99.99% since inception. Oh, but ARK is a scam and shouldn't be allowed to be called an ETF. SQQQ, it's a little risky. Yeah, it's a little risky.
I mean, how much percent was this thing up today? This thing went from a start of $9.67 and it's now at $10.98. This is a heck of a run that you could have caught.
This guy's really good at telling you day trades that already happened.
So there's different ways that you can use ETFs to your benefit. Now the goal of all of this is to tell you SPY, VOO. Those are your two safest bets. If you do those consistently over your lifetime, your working lifetime, you will be in a better place. SPLG, a little bit cheaper, but if you're going for options, it's not going to be the most beneficial for you in that regard. JETS, USO, GDX, they're just different avenues of you to go more sector specific.
Yeah, USO, just to reiterate, USO is not a way to go sector specific. Why would you say in the video, I still don't understand futures, and then recommend it as a way to get sector specific? If you put a wire into Jeremy and Mo's brain, it would not be able to power a light bulb.